Final learning objective, what kind of options do I have? Managerial options, opportunities to exploit. Should I take Euro Disney on if I'm the Disney Corporation? Should I take on Shanghai Disney? And can I exploit those opportunities, or should I wait, or should I abandon if they're not working out? So these are some decisions you'll make in the future. You'll look at real options. So you may have an option to expand into, let's say, Paris or Shanghai. Can we expand the project, repeat it, and get a larger MPV? I may have another option to abandon. Should we just not go there, scale back, and abandon the project? And just wait. The other option is wait. I don't need to move on that Euro Disney right away. And then once I do go into it, I go into it and then I measure to make sure it's a successful project. So these are some of your options. We call them real options. This is called real option analysis. Test the water. Very difficult to measure some of these values. Example, R&D. How do we measure the value of that R&D you're doing? It may not turn into a product for 10 years doing R&D, spending lots and lots of money, and you may get nowhere. You may just have a gigantic hit like Post-it notes. It's a classic example of R&D being very, very successful. If I have to go into rationing, I have positive MPV projects, possibly, but cannot find the necessary financing. So what are my choices? Soft rationing and hard rationing. $500,000 in great projects, but only $200,000 to invest. So how do I allocate that $200,000? I can do soft rationing, try to get a larger allocation, or try to generate the largest MPV with the existing budget that I have. Or hard rationing, where I can't raise financing under any circumstances, and usually this company won't take on any projects and is basically in financial distress. So you don't want to be in a hard rationing situation. Here are some examples to demonstrate scenario analysis. I know I'm doing scenario analysis here because I see the words base case, best case, and worst case. We're just going to do one. How do I get that P&L, that income statement, built at the bottom of the base case example? It's very, very simple. You take the givens up top and then build your P&L. So my sales, 480,000, comes from taking 6,000 units at $80 a unit. Those are my projected sales. Again, these are all guesses. These are most what you think are the most likely case. You think you can sell it for $80 a unit. You think you can produce the product for $60 a unit, and you think fixed costs will be approximately $50,000. So variable cost, I take $60 a unit times 6,000 units, get 360,000. Fixed costs just come down and plug in. And depreciation I got from analyzing the property, plant, and equipment. PP&E is $200,000, and it's going to be depreciated straight line to zero over 5 years. So the annual depreciation expense is $40,000. Plug that in, that gives me an EBIT of $30,000, taxes at 34% of $10,200, and MPAT of $19,800. From this, I can calculate, do all that session 9 analysis on MPV, IRR, AAR, all of that stuff we can do once we build the P&L and a little balance sheet. Anyway, I can do an OCF, which is just equal to EBIT plus D minus T, and I get $59,800 per year. That'll come in for 5 years. My required return in this company is 12%. That's my hurdle rate, or weighted average cost of capital, and I can use that to calculate the net present value of this project. MPV is equal to that initial investment of $200,000 going out plus 59.8, and that's an annuity, so I can take that times 1 minus 1 over 1.12 to the fifth over 0.12, and I get a net present value of 15,567. So in the base case, I accept. In the best case, it's way higher, I accept. And in the worst case, it's negative, and I reject. So there's the value of doing some of that scenario analysis. I can also do the IRR. What is the rate at which my discounted cash inflows equals my cash outflow of $200,000? So whenever I do, and whenever I see the letters IRR, I always write down the following. NPV equals 0 equals minus first cash outflow, $200,000, plus first cash inflow over 1 plus some rate, second cash inflow over 1 plus some rate squared, ... fifth cash inflow over 1 plus some rate that I don't know, X to the fifth power, and I get an IRR of 15.1%. That's higher than our hurdle rate in our company of 12%. So I'm going to accept the base case. I'm going to accept the best case. I'm going to reject the worst case. So same decision as MPV. Looking at an accounting break-even example, let's say we want to go into the diskette business. We have boxes and boxes of old floppy disks or semi-hard disks that you want to get rid of. Price them at $5 each, cost were $3 per disk. Fixed cost of this project, $600. Depreciation, $300. What's the accounting break-even point? How many of these diskettes do I need to make and sell just to break even? Again, the accounting break-even formula is fixed cost plus D over P minus V. And that denominator is contribution margin, selling price per unit minus variable cost per unit. So again, this one's very simple. Fixed cost of $600, depreciation of $300. So you have $900 in the numerator, and contribution margin on these diskettes are $2, 5 minus 3. So I find that the number of units just to break even on an accounting basis is 450 units. I have to make and sell and approve that I get it 0 EBIT, 0 tax, and 0 NPAT. I can just multiply 450 times the given. So 450, my sales will be 450 units of diskettes times $5 a unit, $22.50. Variable costs are $450 times 3, $13.50. My fixed costs are $600. My depreciation is $300. That should give me, if 450 units are correct, that should give me EBIT of 0, taxes are 0, and MPAT is 0. There's your accounting break-even analysis, and you can prove it via P&L, profit and loss statement. Let's look at accounting break-even for a boat business. So, in fact, we'll look at accounting break-even here, cash break-even, and financial break-even. Again, these are all guesstimates. When you first open this business, you think you can sell 85 boats. You think you can price them at $40,000 per unit. Very nice sailboat. Variable cost to build these things is $20,000 per unit. Fixed costs are $500,000 per year. And it's going to cost me $3.5 million to put in a shell and a winch and all the tools I need inside the operation, $3.5 million down in Annapolis. Let's pretend we're going to open this boat company in Annapolis, Maryland, down by the Chesapeake Bay. Time frame is 5 years, straight line depreciation. That'll help me calculate depreciation expense. My net working capital is 0, and my required return in this risky company is very high at 20%. So what's the accounting break-even point? What's the cash break-even point? What's the financial break-even point? So here we'll demonstrate all three types of break-evens that you should be aware of. My sales should be 85 boats times 40,000 a unit, or 3.4 million. Variable cost will be about half that because the variable cost per boat is half the selling price. So simply 1.7 million. Fixed costs are 500,000, and depreciation is 3.5 million divided by 5 years. 5-year project. Straight line depreciated to 0. This is not break even because my EBIT, so 85 boats is not break even, it's above break even, so I need to find the accounting break even. How many do I need to make and sell just so that my EBIT is equal to 0? Taxes are 0 because this company has a tax loss carry forward, so my MPAT in this case at 85 boats is $500,000. Now I still want to know what is the accounting break-even point. So I want to do the accounting break-even quantity, fixed cost plus depreciation over contribution margin. So 500,000 of fixed cost plus 700,000 of depreciation over 20,000 per boat in contribution margin, and I get accounting break-even quantity of 60 boats. Now let's prove that that's right. If 60 boats is correct, I should be able to get EBIT of 0, taxes are 0, and MPAT is 0. My sales are 2.4 million, which is 60 boats times 40,000 per boat. Variable cost is 60 boats times 20,000 per boat, or 1.2 million. Again, half my sales number. Fixed costs are still 500. That does not change no matter how many boats you make. And my depreciation is still the 3.5 million divided by 5 years. So EBIT, if 60 boats is indeed the accounting break-even quantity, should be 0, and it is. taxes are zero, NPAT is zero, and OCF would be depreciation. And we can prove that. EBIT plus D minus D equals 700,000, and that is the amount of depreciation. So there's your accounting break-even quantity example. So what is my cash break-even? This should be a lower number of boats. So in this case, it's fixed cost plus zero over contribution margin, or 500,000 over 20,000 of contribution margin. 25 boats, a very small number of boats need to be made and sold to just break even to the point where OCF equals zero. Again, build a P&L. So 25 boats times 40,000 per boat is $1 million of sales. Variable cost will be half that again, 500,000. Fixed costs are still 500,000. Depreciation still 700,000. That gives me an EBIT of negative 700,000. Still no taxes because of tax loss carryforwards of this company, and my NPAT is $700,000 negative. What is my OCF in this example? Should be zero if I've done 25 boats correctly. So I take EBIT minus 700,000 plus D, 700,000 minus taxes of zero, and I get an OCF of zero at 25 boats. So 25 boats will just give me operating cash flow of zero. And then finally, financial break-even point. This is a little more complex. I have to find the point where how many boats do I need to make and sell where NPV equals zero. So NPV equals zero equals minus the cash outflow of 3.5 million plus some OCF over 1 plus my required rate of return 1.2 plus some OCF over 1.2 squared a fifth OCF over 1.2 to the fifth. And I get an OCF out of that of 1.17 million. That will make my discounted cash inflows equal to my cash outflow and an NPV equal to zero. And then I can see how many boats I need to make and build to generate OCF of 1.17 million. So fixed cost plus 1.17 million over contribution margin of 20,000. And I get a number of 83 and a half boats, which is close to my initial estimate of 85 boats was my initial toss-up number, but to get to NPV equals zero, I need to only make 83 and a half boats. I can prove this, again, using an income statement, P&L. I take the 83 and a half boats times 40,000 per boat to get 3.34 million. My variable costs are 20,000 per boat times 83 and a half boats, 1.67 million. Fixed costs remain the same, 500,000. Depreciation remains the same, 700,000. And I get an EBIT of 470,000. Taxes are still zero because of tax loss carryforwards, and I get net income of $470,000. Again, I take my OCF and figure it out, and it's EBIT of 470,000 plus D, 700,000 minus T of zero, 1.17 million. Is my OCF in this example. So I hope you enjoyed session 11, talking about different types of analysis on major capital investment projects.